Dear friends, welcome to Alan's Academy of Commerce. Today we are going to see about a new topic, financial management. So we'll start with the introduction to financial management. As usually you know, finance is the lifeblood of every business and it keeps the firm dynamic and it is an integral part of the firm. Without finance, no business can be started. So, as it is the lifeblood of every business and an integral part, it plays a very important and pivotal position for a business. Its needs are to be identified. What is the need for the finance? So first of all, for conceiving an idea to business, if at all we want to start a new business, then there should be idea generation to start a new business. For that purpose, we need finance. Next, to promote or establish a business, to keep the business going or to keep the firm going or the business enterprise going, as well as to establish a business. If at all we want to start a new firm, new business, we need finance. Next, to acquire fixed assets. To purchase fixed assets, finance is needed. Next, to investigate market surveys. For launching a product, finance is needed. Then, to develop a product, finance is needed. To maintain men and material to work, finance is needed. For the management progress, finance is needed. For growth of the management, finance is needed. To create value, if at all a business has been established and it occupies a very branded position, a very high esteemed position, then the goodwill of that business creates a value. For that, finance is very important. Then, for expansion of a business as well as improvement of a business, finance is important. Now, the next question comes, how to manage the finance? It is very important. So, finance should be managed in a profitable manner. If at all the company aims at profit, then finance should be managed efficiently. Next, to reach its full potentials, all the departments are being organized and it reaches the ultimate goal. The ultimate goal is profit, aiming of the profit. Therefore, to reach its full potentials, to reach the goal of the organization of the enterprise, finance is a must. Finance is needed. Then, for the growth and success of a business, finance is needed. Therefore, it should be managed efficiently so that only then the maximum profits can be attained. Now, we are going to topic financial management. Actually, financial management is a new management discipline and it was a branch of economics till 1890s. Only then there was lots of transformation in this financial management. It was a branch of economics. Only later it was developed as a separate subject. And when it was developed as a separate subject, its importance was being sought by the academicians and practicing managers. Now, how come the importance was being sought? Then, this finance plays a very crucial role in decision making. If at all a business has developed or it is on the starting stage or the preliminary stage, then decision making is very important. How to cater to the needs of the organization. So, for important decision making related to financial management came up with conceptual and analytical insights. So only when it was being determined as a separate subject, then the importance were taken up by the academicians and practicing managers as financial management turned up to a separate subject or a separate discipline. So we just had an idea about this financial management. Now, I've just made it very simple for you to understand the meaning of financial management. Financial management is flow of funds flow of funds in a firm. It relates to timely procurement of adequate finance. The firm has to get finance in a proper time. It means the finance should not be more, nor the finance should not be less. If it is more, it becomes idle. If it is less, it becomes inadequate. So, for a firm, the timely procurement of adequate finance is needed. Now, how the firm procures this? From various sources. As you know, what are the various sources? The sources can be the investors, the sources can be the investment bankers or financial institutions. The firm gets finance from various sources like banks, financial institutions, investors, investment bankers, etc. Now, this finance what you have procured should be effectively utilized. That is very important. There is a difference between efficient utilization and effective utilization. What is efficient utilization? For what purpose that fund was being procured, it should be used economically. That is efficient utilization. What is effective utilization? Effective utilization is there should be a predetermined objective. What is predetermined objective? For what purpose the fund has been procured, whether it is a short-term objective or a long-term objective. That should be determined by the department, by the financial department or the finance department. So, the flow of funds is very important. The timely procurement of funds is important. Adequate funds has to be procured. What are the sources from which the funds are being procured and how it is being effectively utilized. That should be identified by the management or the organization or the enterprise or by the finance department. Now, how the attainment of the goal of the firm can be identified? By raising the funds, and if it effectively utilizes the funds, it attains the goal. So, actually financial management plays a very vital role in every business because without finance, no concern can function. Finance plays an inevitable position in every concern or in business. Next we go on with the third heading, the definition of financial management. Now, there are various experts who have given the definition. We will go one by one. I have made it very simplified definition I have taken for you. So, the first definition given by Weston and Brigham is as follows. Financial management is an area of financial decision making, harmonizing individual motives and enterprise goals. Now, here three aspects have been given. What are that? Financial decision making. Decision making plays a very crucial role. How the funds are to be procured, the timely procurement of the funds, and how it should be scattered to the different departments. That should have a concrete decision making by the financial manager. So, what happens if it is being done like that? It harmonizes individual motives and ultimately the enterprise goals. It leads to profit maximization for the concern. That is the goal of every organization or a business. So, the first definition given by Weston and Brigham. Next one, we will go with the next definition of Joseph and Massey. What they have said is, financial management is the operational activity of a business that is responsible for obtaining and effectively utilizing the funds necessary for efficient operations. Here 4 points have been identified. 1. It is the operational activity of a business. What do you mean by operational activity? For day-to-day functioning of the business, finance plays a very important role. Without finance, the day-to-day operations of the business cannot be done. So, it is an operational activity of a business. Now, that is responsible for, that leads to what? Obtaining of funds, procurement of funds. That is the meaning. And Next thing, effectively utilizing the funds. Once they procure the funds, that cannot be kept idle. It should be effectively utilized. What happens if it is effectively utilized? It leads to efficiency in the operations. So these are the 4 points identified by the expert Joseph and Massey. It is an operational activity. It relates to obtaining of the funds. It should be effectively utilized for the efficient operations. Now the next one, we'll go with the 4th aspect, the scope of financial management. Now, what is the widened spectrum of financial management? So as I told you, procurement of funds, timely procurement of funds, and effective utilization of the funds. Now, the broadened area, it was being identified under 2 aspects. One is the traditional approach, another one is the modern approach. Now, what comes under this traditional approach? The meaning of this traditional approach was, it was confined only to raising of funds. That means, the organization first of all identified that raising of funds only is the most important criterion for running a business. So, this idea was being very narrow on the part of the organization. Why? Because the idea was being done only to procure the funds. How they can procure the funds? That was only the idea of big enterprises. Now, this idea used to be done only by corporate enterprises to meet the financial needs. How they met the financial needs? Just by procuring the funds from various sources. It can be bankers or financial institutions or investors. Therefore, when the corporate enterprise made an idea only to raise the funds, it was called as the corporation finance. Previously, in mid-1950s, during the year 1950s, it was a traditional approach where the financial management was being called as corporation finance, because there was no concern about the allocation of funds. Just they got the funds, that's all, to meet the infrequent needs. That can be infrequent sometimes. What can be the infrequent happenings in a concern? There can be mergers. Mergers, or what we say, amalgamation. Is amalgamation means 2 concerns merging together and forming a new concern. Or there can be acquisition. One concern buying the other one. Buying or purchasing or selling the other one. This is acquisition or reorganization. For this purpose only, finance was being procured by the big enterprises. So this happened in mid-1950s and there was no concern of allocation of funds. That is why it was termed in a narrow sense. So when it was termed in that narrow sense, there was various limitations in traditional approach. We can see one by one. First one was, it was outsider looking in approach. Outsider looking in approach means the firm had the funds generated from the outside sources. For example, as I told you, big financial institutions or giant financial institutions, then investors, investment bankers, like that, when the firm started raising or generating the funds. Then the next limitation was the internal financing decisions were ignored. They were just having a support only from the outside suppliers, but they didn't go into the internal financing decision of the firm. Only if the core, that is the internal financing decision of the firm, was generated well by scattering to the needs of the various departments, then it would have led to efficiency of funds. But they just took an approach as only outsider looking in approach. How to generate the funds from the outside sources. but the internal financing decisions were completely ignored. That was the second limitation. The third limitation was it was confined only to infrequent events. They generated the funds, somehow they managed the business, but there came up some infrequent events. What are the infrequent events? Like as I told you, amalgamation or absorption or acquisition, liquidation of a company, dissolution of a firm, then reorganization of firms, like that. So these were the infrequent events because they needed more amount of funds for doing these type of infrequent events. Therefore, the working capital management were ignored. What is working capital management? For doing the day-to-day business activity or for administering the day-to-day business activity, they needed sufficient cash. But these aspects were completely ignored. Working capital management is otherwise. For the day-to-day activity of the business, they needed the rotation of the funds, rotation of cash. But that was completely ignored by the organization or the business. So this was the narrow term for traditional approach. And also they ignored important aspects. Important aspects in financial management has a deeper meaning. We will be going in detail in the other classes, like capital structure, cost of capital, leverages. All these are the important aspects determined in financial management. So for everything it has its own importance. So we'll go in detail in the later chapters about this. So these were the limitations for the traditional approach. The approach was being transformed through modern approach. Modern approach in modern management after 1950s, what happened was there was a shift from procuring of the funds or raising of the funds to effective utilization of the funds. How? The importance was being considered, as previously I told you, by the academicians and the practicing managers, stating that every concern should have a shift from the traditional to the modern. So what is traditional? What is modern? Modern is not only raising of the funds are necessary, but also its effective utilization of the funds are very much needed for the success or growth of a business enterprise. So every business started thinking of wise use of funds. What do you mean by wise use of funds? How to effectively utilize the funds. So what are the aspects concerned with how to utilize this? They determine various aspects for this. The size and technology that plays a vital role. Then setting directions to business. For this, funds should be effectively utilized. Next, shaping the profitability of the firm. Funds should be utilized effectively. For risk taking, only if the funds are properly scattered to the needs of the organizations, not in very lavish manner or not in inadequate form, then the risk, how it can be taken by the management, by the organization or the business, whether the risk is more or whether the risk is less, or how they are going to have a balance between risk and returns, risk and profitability, risk and returns. Next, selecting the mix of assets. Mix of assets means every concern has debt and equity. Debt, what they borrow from the outside sources. Equity, how they are going to distribute as dividends. So there should be a balance between these two aspects. Next is about determining the optimum capital structure. Modern approach was an analytical way of viewing the problems. In traditional approach, the method of solving the problems were completely ignored. Whereas in modern approach, they started the method of analytically viewing the problems. Analytically for each and every aspect. Capital structure, cost of capital, leverages, decisions relating to dividend, investment, all these were being determined. Therefore, rational decisions played a very vital role in modern approach, because every financial manager started thinking of the funds should be optimally used for attaining the profitability. And therefore, in order to use the funds optimally, there were three major or key decisions. There were three major key decisions to be taken by the financial managers. What were the key decisions? Decisions relating to investment, financial decision, how the portfolio should be done, what is the debt equity mix ratio. This all comes under financial decision. Next one, dividend decision. Out of the profitability, how much should go to the welfare of the shareholders in the form of dividend. So these three decisions played a vital role in modern approach. Therefore, for this purpose, the financial managers had to have extraordinary administrative ability, because the finance is the lifeblood of every industry. If there is any flaw, then it affects the whole organization. So, the finance department should have extraordinary administrative ability, management skills in order to take up a concrete decisions. These were emphasized in modern approach. So, the scope of financial management were diversified under traditional approach, where it was a narrow sense. When it came to modern approach, how the procurement of the funds to be effectively utilized were being identified based on three important decision making aspects like investment decision, financial decision, dividend decision, and therefore the finance plays a very vital role for catering to the needs of the management, and therefore the policy makers of finance should have an extraordinary administrative skill and decision making techniques to solve the various crucial problems of finance. This was the idea behind modern approach. So in other classes we will discuss about the various decisions in detail. So today we can wind up with these classes. So hope you are very clear about this. Kindly subscribe to Allen's Academy of Commerce. Encourage us to proceed further. So if you like it, click on to the like button, subscribe, and please give your valuable comments. Thank you.